As many of you know, the current administration recently enacted a series of tariffs against 3 of our largest trading partners. As of February the 1st, the United States administration has levied a 25% tariff against the countries of Canada and Mexico, and a 10% trade tariff enacted against China. Per the administration, the tariffs have been enacted to first stem the flow of illegal drugs into the United States and reduce or outright eliminate the flow of migrants entering into the country illegally. Tariffs have been used by prior administrations to speed the pace at which mutually beneficial resolutions can be reached for the countries in question. The general ramification for tariffs is an immediate increase in the price of the goods or services coming from the countries affected. In this case, should the administration not reach some amicable resolution with the governments of both Canada and Mexico, effective March 1st, we should expect to see a 25% increase in the cost of goods coming from those countries. Should the governments of both the United States and Canada and the U.S. and Mexico fail to reach some resolution, the products coming from Canada and Mexico will increase by 25%. To my knowledge, as of this report, China has been offered no such reprieve. We should not be surprised if the cost of the goods coming from China sometime later this month by increasing by no less than 10%. What often happens in the event of a tariff situation, you might find domestic prices in the United States for the subject goods in question raising by 25 or 30%, and as a result, the consumers shift their purchasing cycles over to a domestically sourced product to offset the higher priced imported material. As a result, the net desire would be to reduce imports and simultaneously increase domestic demand with domestically filled product. History has shown us that tariffs themselves have a mixed bag of results. Not only do they increase the cost of imported goods, they can simultaneously increase the currency value of the country enacting tariffs. As a result, a stronger dollar overseas results in higher priced goods overseas, which might by default result in reduced demand for domestically produced product in the United States when sold abroad. The immediate effect on the chemical industry has yet to be seen. In my personal opinion, I don't see that we might risk an immediate impact on the chemical industry, but it's impossible at this point to understand what might come out of the law of unintended consequences. When tariffs are enacted in years past, the tariffed countries tend to retaliate by themselves enacting their own tariffs. No sooner than the administration had put a 30-day reprieve on the tariffs associated with Mexico and Canada, China issued retaliatory tariffs against the United States and has curtailed not only the price of goods, but has raised the prices of those goods with their tariffs. It is that tit-for-tat ensuing trade war that might wreak havoc on the chemical business. There are a number of chemical products currently used in the United States who are downstream from impacted materials that we have yet to determine. So while I don't see an immediate impact, I do see that the risk for an impact at some point becomes significantly greater the longer a trade war is allowed to carry on.